again, I know you guys won't get all this, but maybe you'll get some of it. But when people restate their financial statement, it's huge. It hurts their stock value if they're actively traded. It hurts everybody. And that's the reason that most people have to restate their financial statements. Sometimes the SEC will get involved and say, wow, tell me about this revenue recognition. Not necessarily the auditors, but the SEC have their own auditors that go out when they think something's fishy, and they'll look at somebody's financial statements and they'll ask them to restate or explain things. And revenue recognition is the biggest one, basically. So that's the main one why people have to restate, because you think, well, it's so easy. Because here's what we've studied so far on page 1047. Sale of product from inventory, right? Everybody knows how to recognize that revenue. You just book your revenue from your inventory to your income statement on the date of sale. That's cake, okay? Recording of service. Well, when I perform that service, I do the tax return, I do the website, I clean the house, whatever it might be. At the end of that service, that means you can send them a bill and you recognize your revenue based on accrual accounting. So that's pretty straightforward. Permitting use of an asset. You let somebody rent from you. You rent their offices, or maybe it's a franchise and they pay royalties. Maybe you've loaned them money because they're using your asset. They're using your money, so they pay you interest. So as they use your assets, they pay you revenues. And so as time passes, that's when you recognize the revenue. Sale of an asset other than inventory, like that old copier, an old delivery truck, or whatever it may be, you have a gain or loss on the date of the trade-in or the date of the sale. So that's when you recognize the revenues, and we'll call them gains too, revenues and gains on the income statement. Keep in mind that cash is not king here. Based on accrual accounting, you recognize revenue when we've earned it. You've heard that a million times. You record the expenses that we incur to recognize those revenues in the same period, regardless if you've paid for them or not. You've heard me say before that any revenues you haven't collected yet but you've recognized, you're going to have accounts receivables, aren't you? Any expenses that you've recognized on the income statement that you haven't paid for, you'll have accounts payable, right? Everybody see that? I know it's kind of basic, but I want to review that. Okay, well, what's the deal with all this stuff? Well, they've got a new FASB has been put out in the last couple of years about revenue recognition. The ISB, the International Financial Board, and FASB got together on this, and they converged, which is a huge deal. When FASB and the International Accounting Standards Board, they've been working on this for years and years. It's kind of like they're dating. It's kind of like they come together for, they get together on a few things, and then they fuss and fight and fall apart. And they come back together, they fuss and fight and fall apart. And so they're really having an issue of getting together on all the accounting standards. Well, this is one that they've kind of gotten together on, they've converged on, and it seems to be working fairly well, but it's really new. This is the first time it's been in an intermediate textbook, so it's pretty new. Okay? So the main thing you have to remember as you read this week is that we're going to look at performance obligation. And when it's all this right here, you see what we've just reviewed? All of these are performance obligations. I gave them my inventory. They took my inventory, title passes, right? So I've performed my obligation. So I recognize the revenue. You see that? So there's only one performance obligation here, basically. So it's easy. We used to say, well, let's see, did you realize, it's realized or realizable, and did you earn it? That was basically it. And so the problem is that when you get into a lot of industries, it's not that simple. And so FASB is known as more of a rules-based revenue recognizer, and the international is more of a principle-based, more of a, hey, we've got some guidelines, follow them if you want to, hopefully you will. But FASB's more, hey, we've got these guidelines, and they've put out over 100 reports on ways to follow them. So FASB's more rules-based, kind of do it my way or hit the highway, and the International Accounting Standards Board is more principles-based. They lay out a few principles and ask you to follow them. Which one's best? Well, people say different ones are best, but the point is they've kind of gotten together on this new one. So this is what they're trying to follow too. But the main point is of all of these, the performance obligation is met when I give you my inventory my performance obligation is met and I recognize my revenue. When I finish my website, now you have control of the website, I've met my performance obligation and I recognize my revenue. Okay? I'll let you use my asset. As you use up my asset, I've met my performance obligation. And if I sell you my old copier or my old truck, I pass the title to you, I've met my performance obligation. So what we've already studied really won't change. You still recognize revenue as we've learned even from Accounting 1, but we call it performance obligation now. In most things that we've studied are just one performance obligation and you recognize the revenue. Does that make sense? But so they've made it a little more complicated, of course, they would do that. Okay? At the bottom of page 1043, bottom page 1043, they put in the 5-step process you need to memorize. I know memorization gets a bad rap sometimes, but you got to get in your short-term memory before you can get in your long-term memory and all that good stuff. So, anyway, okay, our key objective here, look at that on illustration 18.1. Recognize revenue to depict the transfer of goods or services to customers in an amount that reflects the consideration that the company receives or expects to receive in exchange for the goods or services. Wow. That's pretty wordy, isn't it? But that's what we're trying to do. We're trying to recognize revenue and the right amount of revenue and when we should recognize it, right? How much and when, basically, is what we're after. Now, a lot of companies have contracts with their customers. You don't have a contract with the bookstore. You don't go, they don't sign a contract with you. You don't sign a contract with them, do you? If you want to buy your book somewhere else, you buy them somewhere else. Have you heard what's going on next year? What's going on next year's books? Have they told you?
It's going to be included in tuition.
Say again?
It's going to be included in tuition.
So they're renting the books for you. Okay, so they're going to rent the books for you, and they are going to have your box basically in a big 18-wheeler, and you're going to go up basically and show them your ID, and they're going to give you a box of books. Of course, there are going to be issues with people signing up late and switching classes, but they'll handle that. The Tree of Life knows how to do that. Now that will be included, but like if you have a class that has an access code, that'll be extra. That's not included in the price of your rent or the price of your tuition. But that's really all I know. I don't want to take any questions on it because that's all I know. But it will be different next year. If you want to keep your book, you'll have to pay the difference, and they'll put that on your bill. Or if you lose your book, well, you got to pay the difference because you'll have to turn that book back in basically. So anyway, didn't mean to get into that, but we brought up textbooks. But anyway, you don't have contracts as individuals. This is between businesses and businesses normally. When one business is selling something to another business and we sign a contract. And that contract might have things like, okay, here's the equipment I'm selling you. I'm going to install it for you, and then I'm going to maintain it for you. Or maybe I'll just sell it to you and install it. You can let somebody else maintain it and run it. Or maybe I'll just sell it to you and you install it. But these companies have big time contracts. They're about that thick. I mean, they're huge sometimes. So the performance obligation gets cloudy when we're talking about contracts that you have signed. Now, we know that when we sign a contract, do we debit or credit anything? No, we usually don't debit or credit anything when we sign a contract, right? Usually not. But when we have a contract that goes beyond the end of the fiscal year, or whenever you're going to produce your financial statements, you might produce your financial statements each quarter. And so that means you need some adjusting journal entries to make sure matching is all cool, revenues and expenses are matched properly. So when you have contracts when you have contracts with customers and you have a year end that comes in there, that's when it gets to be a problem. Because if you've met some of the performance obligations for the contracts that you have before the end of the year, that means we've got to recognize some revenues. Because we're not going to have some of those performance obligations in that same contract until next year. And maybe the next year, maybe the next year. It depends on how long the contract is. So the real problem comes into play is when you have a year end that comes in and you still have contracts running that you signed up to. So how much of the revenue should I recognize? Well, it's based on our 5 steps here that we're going to get into. So I want you to think about that for a second. This is only a problem when you have contracts that extend beyond the end of this fiscal year that you're working on. And if it's anything like we just reviewed, well, you know, I sell a book, that's not a contract. I do a website, well, that could be a contract, couldn't it? I mean, it takes a long time to design a website, so there are some issues there. Okay, our 5-step process. Identify the contracts with customers. That's the easiest one. And again, this is usually business to business. This is rarely business to an individual. It's possible, but it's usually B2B. B2B. So you find all your contracts, picture a big file, picture a big box, big file, or maybe a big file cabinet. It's got all your contracts in it. Of course, it's probably going to be on your computer and everybody signed electronically, but anyway. So what is a contract, you ask? Okay. What is a contract? You think, well, I know what a contract is, and I just have business law, and you're right, you do know what a contract is. It starts down here. Basically, these are contracts that you've signed that have enforceable rights. Consideration, offer, acceptance. What's the other one? Legal tender. Have you learned that in business law? Consideration, offer, acceptance, and legal tender. I remember that from many years ago. COAL, C-O-A-L, right? Anyway, maybe that'll help you at some point. But anyway, a contract identifies the enforceable rights that you have. What you've agreed to, what your customer agreed to. What you've agreed to, what your customer. You don't have any enforceable rights to the bookstore, right? I mean, you go over and try to buy a book. If they don't have it, you go somewhere else. Big deal. So there's not a contract between you. So this is when someone, your accounting department that you work for, the company has contracts, significant contracts, and they have enforceable rights basically. Okay? Look at the contracts at top page 1045. And again, I didn't mention this, but if anybody happens to watch this video, the reason we're doing this like this is because my online friend left out this chapter for whatever reason. Anyway, the contract has commercial substance. The parties to the contract have approved the contract and are committed to perform. So some people that are really serious, basically. The company can identify each party's rights. The company can identify the payment terms. And it's probable that we will collect the consideration. The person that you're having this contract with, if they're about to go out of business and you know it, you're probably not going to worry about what we're working on here if they're going to go out of business next week. So, you know, somebody that's solid, somebody's financial statement that's solid, you disregard as a contract if the contract is wholly unperformed. What that means is nobody's done anything. So, if we have a contract and we're coming up to the end of the year and nothing has happened by either party, then we don't worry about this because nothing's happened. It comes into play when I've done something that I agreed to in the contract. Or maybe the other party did something that they agreed into the contract. But if nothing has happened before the end of your fiscal year, you don't have to mess with this. Does that make sense? There has to be something that happened. Each party can unilaterally terminate the contract without compensation. So wait a minute, I'm signing this huge contract. Man, look at all this stuff in here. You know, we spend a lot of money putting this thing together, lawyers and finance people and everything. But there's a line in there that says either party can terminate at any time they want to, and nobody is held accountable. Well, that's not a very strong contract, is it? Not a strong contract at all. So you wouldn't mess with this, basically. So even though you know what a contract is, there are some issues that need to be reviewed to figure out if it's a contract or not. So you identify if it's a contract, okay? So as it tells you here on page 1045, we're not going to worry about it until a contract exists. A contract must exist. You must have enforceable rights and obligations. You must have enforceable rights and obligations. Now notice here right in the middle of that, right underneath, right in the middle of page 1045, the combination of those rights and performance obligations give rise to a net asset or net liability. I would underline that. The combination of these rights and performances. Okay, let's make sure we know what rights are. If you signed a contract, okay, you have to perform to receive the revenues, don't you? So my obligation is to perform, to sell you inventory, to take care of your products, take care of your inventory, whatever my obligation is. That's my obligation. Well, my right is, what am I going to receive in consideration for this? I'm going to perform, I'm going to sell, I'm going to do a website. I'm going to sell you equipment. I'm going to take care of your equipment. So that's my obligation, because we're looking at the revenue side here, right? We're looking at the revenue side, so my obligation is to do something to receive those benefits, which here is a right. I have a right to this revenue. I have a right to these benefits. I have a right. So, if the measure of the remaining rights exceeds the measure of the remaining benefits, this is an asset. And then, of course, the opposite is true too. If the measure of the remaining performance obligation exceeds the measure of the remaining rights, it's a liability. I know that all sounds crazy and vague, but anyway, I'll just kind of leave it at that. Maybe it'll make a little more sense as we go through this. Okay. Notice the entries at the bottom of page 1045. Do those look any different than what we've already learned? Looks about the same. No, there's no magic accounts in there. It's accounts receivable and sales. Then we transfer from inventory to cost of goods sold, the cost of the inventory, and then we collect the accounts receivable. Wow, we did that the first couple of weeks of accounting, right? But now look at the facts. On March 1st, Margo Company enters into a contract to transfer a product to Sun Yun on July 31st. The contract is structured so that Sun Yun is required to pay the full contract price of $5,000 on August 31st. The cost of goods sold is $3,000. So what was the performance obligation here? Delivering the inventory, right? That was the performance obligation. So once I delivered that inventory, my performance obligation was met and I could recognize my revenue. Do I have to wait till I receive the cash? No, because I recognize the revenue here and the cash is here. So based on accrual accounting, cash is not king as far as recognizing revenue. It's still king, but as far as recognizing revenue. Okay? So there has to be a contract, there has to be enforceable rights, and you have to identify all these. Well, what about if the contract is modified, you may ask? I know you're thinking that. Okay? A contract modification. And this gets a little cantankerous, as some people would say. Let's say you got a contract, you're working along, and all of a sudden your customer says, hey, I need to buy more of this. And so you sign a new contract with them. In this little example here, somebody's selling something for $100. I think the contract said they would, the 100 products for $100 each. So they've signed a contract. I will deliver you 100 of my products at $100 each. You see that? All right. So they go on their merry way. They're selling, and I think they sold 60 of them, if I recall correctly. So that's over a 6-month period. So the problem is, again, is there a year end that comes in here? So it's not really a problem on this one. After 60 products have been delivered, Crandall modifies the contract by promising to deliver 20 more products for an additional $1,900.95 each. So they're already selling them $100 each, and now they want 20 more at $95, and you say, okay, well that's cool, you're a good customer. All right, now here's the key. Crandall regularly sells the product separately. In this situation, the contract modification for the additional 20 products is in effect a new and separate contract because it meets both of the conditions above, and you can see those, the red dots. The promised goods or services are distinct. The company has a right to receive an amount of consideration that reflects a standalone selling price. You're going to hear that standalone selling price a lot. Standalone selling price is very important. Not just here, but in a few pages. So if you can identify the standalone selling price at $95, wait a minute, I thought it was $100. Well, the problem says that's what they're selling them for now when the new contract is made. So they were selling for $100. They sold them a bunch, and the price went down on them, And so they said, I'll buy 20 more for 95. And that's a standalone price when they sign this new contract. Okay? So the point is, was it a modification or new contract? All right? Was it a modification or new contract? So, given a new contract, Crandall recognizing an additional $4,100 less 60 they've already sold times $100 related to the original contract, and 20 units times 95 related to the new contract. Total revenue after the modification is $5,900. So since this is a brand new contract, because it meets these qualifications, since it's a brand new contract, we treat them separately. Treat them separately. So there's really no problem. When I start selling for 95, I'll debit accounts receivable and credit sales for 95 bucks. The problem comes in is if it's a modification. If we declare this a modification of an existing contract, then we have to blend the two prices together for any remaining sales. It's a pain, especially when you realize it doesn't make much of a difference. But if it is deemed a modification of an existing contract, we don't go back and change the prices of the ones we've already sold. Okay? You're not going to crack the books open and change those, because this is kind of a change in estimate. And we handle it prospectively. Prospectively means that we handle this in the future. We handle everything to come. We change it. So it only is changed, what we have left is changed prospectively. We don't go back and do anything as a prior period adjustment or anything. Okay, here's what we have to do. Okay, the consideration for products not yet delivered. All right? We've still got 40 that we haven't delivered on the old agreement, right? See, they still got to pay us $100 each for those other ones we haven't delivered, based on 100. And then we've got to deliver them 20 more at 95. So you can see that down here. So you can see we have to blend the two prices together. That's easy. We can do that. So now we divide 5,900 by 60, the 40 that we haven't given them on the old contract yet, and 20 on the new contract, but that we consider this a modification. So you can see we're going to divvy that up to $98.33. So every time we sell one now to them, we're going to debit accounts receivable and credit sales $98.33. So really, don't make this harder than it is. You've got enough to remember, I know. But if it's considered a new contract, it's cake. All you got to do is book the accounts receivable and sales at 95 bucks. And the other one's at 100 that you haven't delivered yet. If it's a modification, you got to blend anything that you still have to fulfill off the old contract. Bring it here. Bring in the new contract. Add it together. However many you have left, and whenever you sell these, that's going to be the blended price. Now look at the top of page 1047. Okay, and that's what I was saying. Really? What a pain. And the total revenue is the same. But it's when you recognize that revenue is the key. So total revenue is the same, but revenue is going to be different after that because of the blended when it's a modification. So anyway, we got to learn it. Somebody might walk up to you and ask you about this someday, right? As indicated, whether modification is treated as separate performance obligation, which is going to be the new one. That's a new contract. The same amount of revenue is recognized before and after the modification. Under the prospective approach, a blended price is used for sales in the periods after the modification. So think blended. Blended goes with the contract is just modified. Then you use blended. If it's a new one, then you just use the new price on the new contract and the old price on the old contract. Wow, that's a lot to go through. Questions on that? Okay, the second step. First step, identify your contracts. Even though that seems easy, you got some issues here. The second step is identify those separate performance obligations in those contracts. So you got your contracts. What are the separate performance obligations? If those performance obligations that you identify are interdependent, depend on each other, you know, and we'll go through an example. If they're dependent on each other, then it's just one performance obligation. So even though they might appear like they're separate, when you read them, they're connected, and one can't go without the other. So that means you put them together in one performance obligation. If they're distinct and they're not dependent on each other, then they're separate performance obligations. And that means we can recognize the revenue at different times, which is what we're after here. Okay. So, I've already seen that. Okay, General Motors. To illustrate, assume that General Motors, this is on page 1048, sells an automobile to market auto dealers at a price that includes 6 months of telematic services, such as navigation and remote diagnostics. And they really hit you up hard for that if you hadn't bought a GM car lately. They really stick it to you and want you to buy that. They usually give it to you a couple months free. But anyway, they're regularly sold on a standalone basis. That's key. You would circle standalone. By General Motors for a monthly fee. After the 6-month period, the consumer can renew these services on a fee basis. In this case, 2 performance obligations exist. You provide the automobile, that's standalone, and then you've got the telematic services are standalone. Both are distinct. They can be sold separately and are not interdependent. So that's a really easy example to get us started, right? Okay, I'm buying the car. That's separate standalone. That's one performance obligation. That dealer would go back and recognize that revenue, wouldn't they? But then they get to decide if they want to buy the telematics, and that's a separate standalone. So even though it's probably on one invoice, it's on one invoice, it's separate. Okay? Well, when would they recognize the revenue for the telematics? Is that what they call it? If you sell telematics, have you earned that service yet when you sell the car? You haven't earned it yet, have you? So that would be in an unearned account, and then as you earn it, you take it out and transfer it to revenue. Because every month you fulfill your obligation, your performance obligation, because you provide them diagnostic services, and you got a nice lady that talks to you when you want directions and all that stuff. So you're fulfilling it every day, but you're not going to make a journal entry every day or every hour of every day. You usually do it at the end of the month to recognize that revenue. So that's standalone. Okay, let's look at case 1, single performance obligation. Softtech licenses customer relationship software to Lopez. In addition to providing the software itself, Softtech promises to perform consulting services by extensively, and that's important, extensively customizing the software to Lopez's information technology environment for a total consideration of $600,000. In this case, Softtech is providing a significant service by integrating the goods and services, the license and the consulting service, into one combined item for which Lopez is contracted. The software is significantly customized to their specifications. The license and consulting services are distinct but interdependent and should be accounted for in one performance obligation. You're going to be dreaming about performance obligations. PO, performance obligations. So anytime it says they're interdependent, even though you can sell these separately, I can sell you the software and you can get somebody else to manage it, and you get somebody else to customize it, but we signed a contract to do both. So when I'm done and I have given you control of your software, and control is a big term here. When do you recognize this revenue? You have to have control. That means that me as the business, when I give up control of the asset, and software is an asset, when I give up control of that asset, you now have control of it. I no longer benefit from it because now you have it. That means you recognize the revenue as well. When you control it totally, I don't have control of it anymore. Now that doesn't mean I can't get in and help you fix it, but I don't have control of it. You have the benefit. So control is a big word. Okay, let's look at the second one. Chin Computer manufactures and sells computers include a warranty to make good on any defect of its computers for under 20 days, often referred to as an assurance warranty. In addition, it sells separate extended warranties to provide protection for defects for 3 years beyond the 120 days. In this case, 2 performance obligations exist. To sell the computer with the assurance warranty. So you know the assurance warranty just means when you walk out of there, you know if you take it home, you're assured that if it doesn't work, they're gonna fix it or give you new. It kind of gives you a little warm fuzzy, having that feeling, assurance. Well, but what about after the 120? Well, if you buy that, that's totally separate. Once I deliver this computer to you and that warranty, the assurance warranty, I've met my performance obligation basically. Since they don't charge extra for that assurance, they don't charge extra for the assurance warranty, it comes with it, right? You don't have any extra revenue there. So when I deliver you the computer, I recognize that my performance obligation has been met. But now, basically for the extended warranty, you know what you do with the extended warranty, that's going to be unearned revenue, isn't it? And then when that warranty kicks in, you'll take it out of that liability and transfer it to your revenue. Usually straight line, something like that. The sale of the computer and related assurance warranty are one performance obligation. They are interdependent. Make sure you're familiar with that term, and interrelated with each other. The extended warranty is sold and is separately sold and is not interdependent. So you really got to view things, how are they connected? Even though they relate, are they connected? And it depends on what the agreement is. It depends on what the contract says. It depends on what the contract says. So identify your contracts, then identify your performance obligations. Lauren?
In the problems that we do in class, are they going to state that it's interdependent and not, or do we need to figure that out like with our own?
Might be a little bit of both.
Okay.
Probably a little bit of both. I mean, it'll be obvious though.
Okay.
I mean, it's going to give you a hint. It's really difficult for us to figure that out. All right. So now we got to determine the price. Okay. We've identified the contract. We've identified the contracts. Now we've ID'd our performance obligations. And yes, somebody's got to go through the contracts and figure all this out, right? So more jobs for accountants. Hey, how about that? More job security. Somebody's got to go through and figure these out. And some of you guys will be auditors. Auditors that have companies that have contracts, you have to understand this stuff. And these will be, whatever industry they're in. If they're in the automobile industry, that'll be distinct. Insurance industry, that'll be distinct. Restaurant industry, whatever. They'll all have their different nuances and they'll all be distinctive. Well, what is a performance obligation for this industry? And so as an auditor, you have to be aware of that. And again, you'll learn that. You can't learn all that here, obviously. But you will learn those nuances in all those industries that you will have to work in. Usually as an auditor, you'll kind of specialize. Like, healthcare is huge in town. And, a lot of the auditors, you have to know healthcare is huge. And you need to know performance obligations if there are contracts basically, in other industries as well. But anyway, we got to determine the price. Well, that's easy. It says it right in the contract. Well, no, it's not that easy. Okay, there's going to be variable consideration, time value consideration, non-cash, and consideration paid or payable to a customer. What? Wait a minute. I'm the business person. I'm selling stuff to my customer, and look what it says. Consideration paid or payable to the customer. That's kind of weird. But when you sell products to Target or Walmart, and those types of places, you really want their business, don't you? You want their business bad. And you're going to give up discounts. And if they advertise your product on their website, if they advertise your product that they're selling on the stuff they send out in the paper and everything, they will give you rebates for that. Okay? You advertise my product, you're helping me advertise it, even though I have to sell it to you and then you sell it to somebody else. They have deals worked out where they receive rebates and those kind of things. So I'm going to owe them. Now what you usually do is just net it out, right? I charge you $1,000 for this. Okay, you advertise my product. You only got to pay me $980. They'll work those things out. But in essence, you're paying them, aren't you? By them giving you less, you're paying them. Does that make sense? Same thing. It's just the same thing. So it's kind of cool, really. Okay, variable consideration. So again, we're trying to determine the price of all of our contracts. The company estimates the amount of variable consideration it will receive from the contract to determine the amount of revenue to recognize. Companies use either their expected value, which is probability weighted sometimes, or the most likely amount. Wow, these are kind of vague terms. Yeah, there's a lot of room in here for to go one way or the other. All right. is illustration. Illustration 18.9. Probability weighted in a range of products, a range of possible consideration amounts, may be appropriate if a company has a large number of contracts with similar characteristics and can be based on a limited number of outcomes. Most likely amount, the single most likely amount in the range of possible consideration outcomes may be appropriate if the contract has two possible outcomes. So, let's look at the example on an estimated variable. Peabody Construction enters into a contract with the customer to build a warehouse for $100,000, okay? And then they're going to say, hey, if you get done on this date, I'll give you another $50,000. Wow, you're going to work your off so you can get this. Well, then every week after that, the $50,000 goes down, is it 10%? It goes down 10% because they want you to get this thing done. Now, the point is to this, that you have a lot of experience in these types of warehouses. So you can look back on your past history and say, all right, we got a good team here, got a good team. Based on our past history of this type of warehouse, these are the likelihood percentages, based on our past history, that we'll get this done 1 week after the date, 2 weeks after, 3 weeks after. Now again, this is only important if the contract runs beyond the fiscal period, right? You see that? Because if we finish it up here, it's not an issue, is it? If we finished it up, hand the keys over to the person we sold it to, we've got it done so we know what to recognize, right? But the point is, in this period of time, if this fiscal year end comes in here, and we're making our entries to accrue all of our revenues, we got to figure out, okay, well, what's the likelihood of us getting this extra 50? Okay, what about if we just get 40 of it? Because we kind of need to book it over here. Kind of. Okay, what they did here, they looked in their history and said, okay,